Once again, at the heart of the action. Interesting story in the Telegraph. I do not know what to make of it. You're going to have to tell me. Feel free to leave a comment. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. So here's the headline. Trump to offer Putin minerals for peace. And you think to yourself, aren't U.S. senators and congresspeople calling it a critical minerals crisis? And now the United States is offering Russia minerals for peace? What's going on here? So you take a closer look. This is dated August 13th, so this is before the meeting. But it's an exclusive that the Telegraph had, so perhaps a window onto some of the things that were discussed here. This is by Connor Stringer and Joe Barnes. Donald Trump is preparing to offer Vladimir Putin access to rare earth minerals to incentivize him to end the war in Ukraine. Again, you think to yourself, wasn't there just a shortage? But it will all make sense shortly. Then they discuss the upcoming meeting, where proposals include giving Putin access to the rare earth minerals in the Ukrainian territories currently occupied by Russia. So I guess the thinking here is the U.S. made a deal with Ukraine for the minerals, and even though Russia has basically, for lack of a better term, conquered the territory, now the U.S. is saying, we'll give you access to the minerals in your territory, should you be interested in peace. So, however you view that meeting, here we are again as the metals and minerals industry, as Teo Yameogo would put it, at EY, rather than the mining industry, the metals and minerals industry, here we are playing a crucial role in how the world and history plays out. How interesting is that? So, as we look at these little stories on copper, on gold, on silver, on lithium, name your metal, to a certain degree, I would argue what we have here in this Telegraph article is more evidence for the importance of these metals and minerals in how really history plays out in the historical narrative. And the reason why I emphasize this and kind of return to this theme often is because, as I often mention here, 10 years ago, there was zero interest outside of the mining industry for metals and minerals. And yes, I am generalizing, but again, it's just worth recalling, we'd be there at conferences and we'd be listening to CEOs, lament the fact that their daughter was basically not proud of their dad that was a CEO of a mining company. Perhaps there were other forces at work there too, but we don't hear those stories anymore. It's not quite the same situation. We are no longer ignored. In fact, as an industry, we're increasingly crucial players, as we see with the rare earths. The U.S. government is now putting $1 billion more into basically critical minerals. And finally on this, it does give a window perhaps into what the administration was thinking, several months ago when they were pursuing this minerals deal with Ukraine. Did they ultimately see it as a point of leverage for any future negotiations? I think that's also worth mentioning because that is not really how it was interpreted at the time. At the time, it was more seen as a kind of cash grab where Ukraine, if you want the United States to continue helping you, you got to give us something here. An almost mercenary-like situation where the United States was perceived as basically saying to Ukraine, if you want us to keep funding this war and giving you weapons, you have to give us something. You have to make a deal with us. Now, one wonders if this was the plan all along to get a point of leverage. And what is that point of leverage? It is metals and minerals. So let's continue. On to the rare earths front. Another fascinating development here, this time from the Financial Times. China cracks down on foreign companies stockpiling rare earths. This is interesting, and this was published August 15th, so late last week. Beijing determined to retain leverage over supply by preventing buyers from building large inventories. So here we go again. More metals and minerals as leverage between the superpowers. I mean, that is literally what we're seeing here. So let's look at this story. This is Joe Leahy and Ryan McMorrow in Beijing for the Financial Times. China has told foreign companies not to hoard rare earths as fears about Beijing's export curbs drive up demand for the metals vital in a range of critical technologies. Beijing is warning buyers they are at risk of greater supply restrictions if they stockpile rare earths and derived products such as magnets used in electric motors, according to two people familiar with the matter. China, quote, is telling companies they cannot go out and build huge inventories in rare earths or they will face shortages, end quote, one of the people said. And if you're to speculate here, as we like to do, one imagines this is all about the military applications. Because from the sounds of it, and we're going to see another article in The Economist, it sounds like Western militaries have been cut off by China. And it sounds like they are not budging one bit on this. It continues. The other person said Chinese authorities were deliberately limiting approved export volumes to prevent foreign stockpiling. Quote, this will be a leverage point from now on, end quote, they said. So metals and minerals, the leverage in present-day superpower negotiation. China dominates the production of rare earths, processing about 90% of the world's supply and making 94% of permanent magnets. It has weaponized that control over the vital industry in the trade war with the United States. Now, again, this 90% number really doesn't do justice, as I've mentioned on several episodes here, to the reality. From my understanding here, reading article after article, the heavy rare earths are actually 99% controlled by China. And those heavy rare earths are often the ones that are used in advanced military applications, such as missiles. So, again, when you see this 90% term that really the media has settled on, it's important to unpack that, as I've discussed previously. Let's continue. Beijing's efforts to prevent companies from building up large inventories, which would give them more flexibility to respond to shortages and price fluctuations, shows its determination to maintain maximum leverage in a sector, the people said. I would argue this is all about the military. That is what is not being discussed here. Because if you have stockpiles, all of a sudden you can easily send that over and sneak that over to your military weapons manufacturers. It continues. China placed 7 categories of medium and heavy rare earths on an export control list in April in response to U.S. President Donald Trump's Liberation Day tariffs. That move, which also covered permanent magnets and other finished products, triggered shortages across a range of industries, particularly automobiles. And this is another, I would argue, oversimplification on the part of the media oftentimes, which is that this is mostly to do with automobiles, but really the rare earths discussion is about the modern economy. I would argue, even though maybe the numbers aren't there yet, the significance of its impact on robotics is as notable as the automobile industry, even though the numbers may not show it yet. So let's continue. While Washington and Beijing agreed to another 90-day extension in their tariff truce this week, China's rare earths controls remain an important part of the negotiations. Quote, this is definitely an issue, end quote, said one person familiar with the talks. Scrolling down, according to a survey by the U.S.-China Business Council carried out last month, half of polled member companies said most of their applications for rare earths had been left pending or were rejected. So that is half. China exported 3,188 tons of rare earth permanent magnets in June, more than double export volumes in May, but down 38% from a year earlier, as we have highlighted on this show. In the 3 months to June, since Beijing enacted the trade restrictions, magnet exports were about half the level by volume in the same period last year. So, in the last 3 months, they were down by half the volume of last year. The USCBC report said that large orders, especially a surge, quote, higher than the applicant's historical averages, attracted greater scrutiny to protect against perceived stockpiling, end quote. Quote, applications are also reviewed line by line. Any discrepancies can result in the delay or return of the application, end quote. People involved in the application process said that with longer wait times, industry associations and business lobbies were frequently raising those with most urgent needs to China's Commerce Ministry, which then generally sped up reviews for companies at the top of the list. China's Commerce Ministry did not respond to a request for comment. The problem has led some Western companies to shift production of finished products to China, a result that suits Beijing as it seeks to increase control of the supply chain. So this whole rare earth issue really appeared as a response to Liberation Day, where the intention was actually to reshore manufacturing into the United States. And so with the rare earth card that China has played, they are fighting fire with fire, aren't they? Perhaps we're seeing unintended consequences of this move where actually factories are now considering moving to China in order to deal with the rare earth situation. Louis Pinkham, chief executive of US-based motor maker Regal Rexnord Corp., said the company had moved some production to China in order to assemble rare earth magnets into products in the country and ease their export. Quote, "For the last 4 months, I've been on 1 or 2 calls every week working with our teams to manage this situation," he said on a call with analysts last week. Quote, "There is no question that this is not a great use of time." Now, The Economist has written, Xi Jinping's weaponization of rare earth elements will ultimately backfire. And this looks like an editorial as there is no byline. This is August 13th. So scrolling down about 5 paragraphs here, it says, "The difficulty for Mr. Xi, though, is that export controls have unintended consequences. Confronted with a ban, companies and entrepreneurs find ways around the shortage. China's dominance in rare earths stems not from exclusive control of the world's deposits, nor from the technological sophistication of the refining process, but instead from efficiency, scale, and convenience." I'll read one more line, but then I want to unpack what we just read there. "And the more it uses rare earths, or indeed other commodities, as a weapon, the more it will encourage others to find alternatives, weakening its future firepower." Now, I think this is generally true. The world will find other solutions. There are solutions here. It is possible, but it could take time. Now, the part that I have reservations on here is to say that China's dominance in rare earths is not from technological sophistication of the refining process, but instead from efficiency, scale, and convenience. First of all, how do you separate technological sophistication from efficiency and scale and convenience? Are those not part and parcel of the same thing? Now, to be fair to The Economist, I think what they're saying is this isn't impossible to do, and there are, companies that are working on this problem. But I keep coming back to James Dines, 15 years ago, describing the refining process as much an art as a science. You listen to interviews with some of the experts on rare earths, they talk about how really complicated this process is, and talking about things are just one ion separated, and some of the stories we're seeing in the US, I think it was the White Mesa Mill is hoping to create 1 kilogram of heavy rare earths by November. Hoping, planning, intending, but as far as I can tell, don't have it yet. So I don't see this as so separated. Because ultimately, why then will it take several years for the West to put together an alternative? Is that not a technological issue? And I would argue it has everything to do with the technological sophistication of the refining process. So I'm not sure about this argument. Generally speaking, I think we could agree that if China restricts rare earths, yes, people will find a way around the solution, whether it's reducing their use of rare earths or creating their own production line, which is happening. But it's going to take time. And again, I see it completely as a technological sophistication. Like, this isn't a money problem. If this was a money problem, this problem would be solved. So it is a technological issue. Why is China, basically telling rare earth experts in the country, give us your passport and do not share any information? To the point where we've seen stories here where China is meeting with the postmaster, with the entire chain of people who could be involved in exporting the rare earths. They met with the suppliers, they met with the scientists, right? And they had a big meeting. on this and they're taking passports. They don't want these people to leave the country. And you're telling me that this isn't about technological sophistication? So continuing on, another angle on this story, we have a BBC story from 6 days ago, inside Australia's billion-dollar bid to take on China's rare earth dominance. This is by Suranjana Tiwari. Scrolling down the article, for decades, Iluka has been mining zircon in Australia, a key ingredient in ceramics and titanium dioxide used in the pigmentation of paint, plastics, and paper. It just so happens the byproduct of these mineral sands include dysprosium and terbium, some of the most sought-after rare earths. Over the years, Iluka has built up the stockpile and is now worth more than $650 million. That was the easy part, however. The processing or refining is another matter altogether. This is Professor Jacques Eckstein, Chair for Extractive Metallurgy at Curtin University. Quote, they're chemically very similar, so to try and separate them requires a huge number of stages. Professor Eckstein explained, quote, also you've got residues and wastes that you have to deal with out of this industry, and that's problematic. They often produce radioactive materials. It comes at a cost. And that is one of the reasons the Australian government is loaning Iluka $1 billion US to build a refinery to meet demand for rare earths, which Iluka sees growing by 50 to 170% by the end of the decade. Quote, we expect to be able to supply a significant proportion of Western demand for rare earths by 2030. Our customers recognize that having an independent, secure, and sustainable supply chain outside of China is fundamental for the continuity of their business. This refinery and Iluka's commitment to the rare earth business is an alternative to China. End quote. The article continues, but the refinery will take another 2 years to build and come online. So again, at this point, this is still hypothetical. Because why is this taking 2 years to put online? Is this so that they can build the machines? I mean, if this is a military issue, why is it going to take 2 years to come online? I mean, can't there be a kind of Manhattan Project here? To me, I think we're back to the technological sophistication. It'll take another 2 years. Quote, without the strategic partnership we have with the Australian government, a rare earths project would not be economically viable. End quote, Mr. McGrath says, referring to Dan McGrath, head of rare earths for Iluka Resources. So solutions are coming, but again, we're kind of looking at 2030. So more investment going into this rare earths issue. And on that front, we have a headline from Reuters. U.S. proposes nearly $1 billion in funds for critical minerals and materials. This is Reuters via mining.com. The Trump administration is proposing nearly $1 billion in funding to speed the development of U.S. critical minerals and materials used in everything from electric vehicle batteries to semiconductors, the Energy Department said on Wednesday. The department intends to offer funding to advance and scale up mining, processing, and manufacturing technologies in the critical minerals and materials supply chains, sectors that have been dominated by China and other countries, the statement said. And we have a quote from Energy Secretary Chris Wright. Quote, for too long, the United States has relied on foreign actors to supply and process the critical materials that are essential to modern life and our national security. End quote. So $1 billion from the Department of Energy to invest in metals and minerals. And another headline, U.S. eyes minerals cooperation in province home to Reko Diq. Of course, that's Barrick's massive copper project. So now it looks like the U.S. is starting to get ahead of the financial markets here. Not waiting for copper to go to $20 a pound in order to start securing copper supplies, it seems. And we have a picture of Marco Rubio here, this by a staff writer at mining.com. The United States signaled a renewed interest in partnering with Pakistan on critical minerals and hydrocarbons, with Secretary of State Marco Rubio highlighting the potential for joint economic ventures in a statement marking Pakistan's Independence Day. The announcement comes amid a thaw in Washington-Islamabad relations and follows a recent trade agreement that Pakistan says will lower tariffs and attract greater U.S. investment. Pakistan's Commerce Minister Jam Kamal indicated that U.S. companies will be offered opportunities in Balochistan's mining sector, including lease concessions and joint venture arrangements with local firms. Balochistan hosts some of Pakistan's most significant mining assets, among them Reko Diq, one of the world's largest undeveloped copper-gold deposits. Operated by Barrick Mining in partnership with the governments of Pakistan and Balochistan, The project is forecast to generate over $70 billion in free cash flow and $90 billion in operating cash flow across its lifespan. And continuing on, just a few headlines on the refinery front. South32 says to mothball Moselle, flags $372 million hit. This is Reuters via mining.com. As it says, Australia's South32 on Thursday flagged a $372 million impairment on its Moselle aluminum smelter in Mozambique and said it was set to place the facility into care and maintenance once its current power supply agreement expires next year. An aluminum smelter struggling? Meanwhile, Tsingshan to invest $800 million in Zimbabwe steel plant. This is Reuters via mining.com. Chinese nickel producer Tsingshan Holding Group plans to invest $800 million in its steel plant in central Zimbabwe through its unit Dinson Iron and Steel Company, a top company official said at a media tour on Friday. So China continuing to invest and build out in metals processing, this time in Zimbabwe. And so some big stories from the last week that we are looking at over here at the Northern Miner Podcast. Coming up this episode, I'm very pleased to welcome for the first time Blake McLaughlin, VP of Exploration at Axcap Ventures. He discusses the state-of-the-art of exploration in the mining industry. So what explorers think about when they are approaching a mining project, what matters, and how a company assesses the value of a project, and how important data is in that equation. So fascinating interview with Blake McLaughlin, VP of Exploration at Axcap Ventures. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. And turning to the website, we have a column by Andy Holm over at Reuters. This is via mining.com. Lithium's rally is supercharged with speculative spice. News that China's battery giant Contemporary Amperex Technology, or CATL, has suspended operations at its giant Jingzhawo mine has lit a fire under the lithium market. The CME lithium carbonate contract has surged by 27% since the start of August, breaking a long-running downtrend with the bull market momentum sweeping through the shares of listed producers. The market reaction is not irrational. Zhengzhawo is China's largest lithium mine, and even CATL's anticipated 3-month suspension will make a significant dent in a massively oversupplied market. Nor is it the only Chinese producer in the lithium hub of Yichun facing heightened bureaucratic scrutiny. But the price surge looks over-exuberant. Any underlying market signal has been swamped by speculative excess on China's Guangzhou Futures Exchange. And scrolling down, trading activity in the options contract mushroomed from 2.9 million lots in June to 8.6 million last month. The exchange's volume figures denote both buy and sell transactions, but even allowing for this double count, July's turnover was many multiples the size of a global market that is growing fast but still amounts to around 1.6 million tons each year. And so Andy Holmes pointing out that there is a lot of speculation. And scrolling down a little further, last month's price action on the Guangzhou lithium contract was, quote, a masterclass in sentiment-driven volatility. According to Paul Lusty, head of battery raw materials at price assessment agency Fast Markets. Fast Markets' view is that, quote, beneath the surface, demand remains tepid, inventories high, and buyers cautious, underscoring a disconnect between price action and market reality. End quote. So an interesting column from Andy Holm over at Reuters on speculation in the lithium market. And as you're going to see in metals prices, quite a jump again this week in lithium. And there was just an election in Bolivia that occurred on August 17th. There was a story that came out earlier from Reuters about it, about what you need to know. And according to a Bolivian friend of mine, the socialists have been run out after 20 years. And there's going to be a runoff on October 19th because there is no decisive winner on the 17th. Continuing on, Chile says lithium contract approved for state-run Alto Andinos project with Rio Tinto. This is Reuters via mining.com, and this was posted yesterday. Chile's mining ministry on Monday said a lithium operating contract for the Alto Andinos project to be run by state mining company Enami is ready to be signed. Enami will partner with global miner Rio Tinto on the project. The mining ministry did not specify when the signing will take place. So, as we see in this business, with the rise in prices, renewed interest in lithium projects. Continuing on, toxic spill at China-owned Zambian mine 30 times worse than expected. This is Bloomberg News via mining.com. The partial collapse of a waste dam at a Chinese state-owned copper mine in Zambia may have released 30 times more toxic sludge into the environment than previously reported, according to an independent evaluation of the disaster. At least 1.5 million tons of the poisonous substance escaped when a reservoir failed at the Sino Metals Leach Zambia mine near the northern city of Kitwe, findings from the company hired to assess the environmental damage showed. That would fill more than 400 Olympic-sized pools and rank the incident among the mining industry's worst catastrophes globally. The government and the company had previously said 50,000 tons spilled in the February disaster. Video evidence from social media and field data show this to be grossly inaccurate. Visit Zambia, hired by Sino Metals to conduct an environmental audit of the accident, said in a June 3rd letter seen by Bloomberg and verified by the company. Visit described the event as a, quote, large-scale environmental catastrophe, end quote, that threatened drinking water, fishing stocks, and farmland in the area. So, the Zambia copper mine, the damage much worse than originally reported. Continuing on, just south of Zambia, Zimbabwe labs overwhelmed as gold rally spurs exploration, miner says. This is Reuters via mining.com. Zimbabwean laboratories are struggling to cope with a surge in mineral samples submitted by mines ramping up exploration activity in response to record gold prices, a mine executive said on Wednesday. So boom times in Zimbabwe. Continuing on, U.S. sanctions armed group Hong Kong firms over Congo mining. This is Bloomberg News via mining.com. The U.S. sanctioned an armed group and 2 Hong Kong-based firms allegedly linked to violence and illegal mining in the Democratic Republic of Congo, part of what officials said was an effort to combat the trade of conflict minerals from the region. The Treasury Department's Office of Foreign Asset Controls imposed penalties on Pareco FF, a successor movement to what it said was an armed group with a history of destabilizing activities in the DRC, according to a statement. The group, quote, imposed forced labor and executed civilians in mining areas under its controls, end quote, the Treasury said. In a follow-up headline, Congolese mining company rejects U.S. allegation following sanctions. This is Reuters via mining.com. The Congolese mining company sanctioned by the United States this week has said it, quote, categorically rejects, end quote, allegations linking it to armed groups and mineral smuggling in turbulent Eastern Democratic Republic of Congo. So it is being denied, as CDMC said in a statement received by Reuters, quote, we are not the perpetrators, but the primary victims of the armed conflict and pillage that have destabilized this region, end quote. The presence and taxation of mining activity by armed groups, such as Pareco FF and more recently the M23 rebels, have prevented CDMC from exercising lawful control over its concession, end quote. So more trouble in the Congo. And finally, a few headlines. India proposes minerals exchange to regulate metals trading. This is Reuters via mining.com. India's Ministry of Mines has introduced a bill in the lower house of Parliament to establish a national minerals exchange aimed at regulating the trade of minerals and metals, a copy of the bill showed. The proposed exchange would facilitate trading in minerals and metals under rules framed by the central government. So this theme of government intervening further and further into the mining sector continues. Another headline, Adani's new copper smelter in India applies to become LME-listed brand. This is Reuters via mining.com. A major new copper smelter in India owned by Adani Enterprises has applied to become a listed copper-producing brand with the London Metal Exchange, the LME said in a notice on Wednesday. And continuing on, Barrick Shandong Gold aim for $400 million investment in Argentine mine. This is Reuters via mining.com. As well in Argentina, Glencore seeks $13 billion in incentives for Argentina copper projects. That's Bloomberg News via mining.com. And also in Peru, Peru's copper production rises in June, backed by Chinese firms. And that is Reuters via mining.com. And another headline out of Peru, MMG warns Peru election poses risk to Las Bambas copper mine. That is Bloomberg News via mining.com. And last few headlines here, BHP posts 5-year low profit on weaker iron ore prices. That is Reuters, and you can read the whole story on mining.com. And finally, zinc market shrugs off low LME stocks as another false signal. And that is another column from Reuters via mining.com, and that is courtesy of Andy Home, staying on top of the metals markets there over at Reuters. So those are your news stories. Now let's turn to metal prices. Turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.34%. That is 0.06% higher than last week. The UK 10-year gilt is yielding 4.76%. That is 0.16% higher than last week. Italy's 10-year bond is yielding 3.6%. That is 0.08% higher than last week. Germany's 10-year Bund is yielding 2.78%. That is 0.08% higher than last week. And the Japanese 10-year bond is yielding 1.59%. That is 0.09% higher than last week. And finally, the China 10-year bond is yielding 1.77%. That is 0.06% higher than last week. So across the board, yields are higher. One wonders if that Japanese 10-year bond at 1.59%, actually the highest we've ever recorded here since we started in the last 6 months since we started covering it. You wonder if that's starting to raise some eyebrows. The German 10-year Bund at 2.78%. We're starting to approach 3% on the German 10-year bond, whereas 6 months ago we were at 2.3%. Interestingly, Italy's 10-year bond at 3.6% is actually quite a bit lower than, say, a year ago when it was at 4.7%. So how interesting is that? Overall, yields creeping higher, frankly, starting to look a little bit like yellow flags, particularly in Japan. Let's turn to precious metals. Gold is trading at $3,383 even per ounce. That is $19 lower than last week. Silver is trading at $38.05 per ounce. That is 13 cents higher than last week. Platinum is trading at $1,326.70 per ounce. That is $6 lower than last week. And palladium is trading at $1,112.50 per ounce. That is $29 lower than last week. Turning to industrial metals, copper is trading at $4.46 per pound. That is 2 cents higher than last week. Iron ore is trading at $101.62 per metric ton. That is 40 cents higher than last week, so basically unchanged. Aluminum is unchanged at $1.17 per pound. Lead is a penny lower at 90 cents per pound. Nickel is trading at $6.87 per pound. That is 18 cents lower than last week, and flirting with near-term lows. Tin is trading at $15.28 per pound. That is 3 cents higher than last week. Cobalt is unchanged at $15.12 per pound. Lithium, the real standout here, is trading at $11.52 per kilogram. That is $1.15 higher than last week, so jumping again after seemingly bottoming at $8.34 just about 2 months ago. So big moves in lithium. Uranium is trading at $73 even per pound. That is $1.05 higher than last week. And zinc is trading at $1.26 per pound. That is 2 cents lower than last week. Zooming out, it looks to me that there is a general consolidation going on across the board, with lithium being the real standout here, and nickel below $7 at $6.87. And those are your metal prices. Coming up, I'm very pleased to welcome for the first time to the Northern Miner Podcast, Blake McLaughlin, Vice President of Exploration at Axcap Ventures. We discuss the latest technology that explorers are using, including the preeminent importance of data. A fascinating interview with a real-time perspective on what is happening in the mining industry from the explorer's point of view. I hope you enjoy the conversation, and I will see you on the other side. Joining us today, I'm very pleased to welcome to the Northern Miner podcast for the very first time, Blake McLaughlin, Vice President of Exploration at Axcap Ventures. Blake, welcome to the show.
Thanks for having me, Adrian.
It's a very interesting topic that we are going to discuss here, which is the nature of the gold supply, declining grades. It's something that Mark Bristow has brought up, of course, the CEO of Barrick. And it's a general concern, across many metals in the industry, including, say, copper. You're more oriented to gold, though. So for those that aren't familiar with your background, could you maybe just give us a little bit of basically how you became VP of Exploration at Axcap Ventures, in a sense? Tell us a little bit about what you're up to.
Yeah, so I have a technical background, worked as a geologist for the last decade and a half, and really through all levels of the project cycle. So from exploration to early stage development assets and through, bringing projects through construction and into commercial production. I've really seen the timeline that it takes to do this, the effort and some of the risks along the way. And so then really we took a position that gold was going to move substantially forward a little over a year ago. And with that view, tried to acquire some high quality assets in stable jurisdictions.
Now, you were also with Argonaut Gold in the past. Is that right? You were a chief geologist?
Yeah, exactly. So that was before we started Axcap. That was my most recent role. And with that company, I came in as a seventh employee in Canada. We got a corporate build decision and brought the mine into production, sold the asset to Alamos Gold in spring of 2024. And at that point, that's when we started Axcap.
Okay, interesting. And just finally on your background, did you study in Canada or did you study somewhere else?
I did, Canadian educated. So I went to McMaster University in Hamilton, Ontario. And I have a kind of a combined geology geophysics degree, which set me up well for the early stage exploration that I did early in my career.
Okay, excellent. Now, in terms of gold supply, then, again, as I was mentioning in the intro, it's kind of becoming a bigger issue, or so I'm hearing. From your perspective as, say, VP of Exploration at Axcap and former chief geologist at Argonaut Gold, what is your sense of, grades, discoveries? How are we doing in terms of finding new gold discoveries? Is it kind of far and few between? What is your sense of that?
The metrics that we've seen really have shown over the last decade to 15 years that exploration expenditures have been relatively flat globally. So companies haven't been, ramping up their exploration efforts. And you couple with this deposits getting more difficult to find, it's really put a sharp decline in new discoveries globally. It's challenged the supply side. Really a big part of that, we've seen lower grade operations come into production. Operations that historically were maybe high graded or were viewed as uneconomic. The change in commodity prices and also our ability to mine at scale have allowed us to mine those deposits economically today. Magino that we built for Argonaut Gold was a prime example of that, where it was a 5 gram per ton underground mine in the 80s. Everyone knew there was a little bit of gold around in the rocks, but it was never able to be mined economically. It shut down in the early 90s and stayed dormant until, the mid 2020s with a new gold environment and basically an economically viable project that could move forward. And now is part of what looks like it'll be one of the larger mine complexes in Canada.
So, as you were saying, it is partly a function of price. How much is technology coming into the equation? How big of a difference does that make? How much have things changed?
I wish I could say they've changed a lot more than they have. It seems like we're still, we are still mining a lot of deposits the way we have for quite a long time. We've been able to scale things substantially. So we do use a lot bigger trucks and a lot bigger excavators these days than we have in the past. That's certainly benefited the bottom line on these deposits and a big part of what's allowed us to bring them into production. That's where we'll see kind of the next evolution, though, from my perspective, is more integration, autonomous fleets, more AI integration into efficiency on projects to really optimize them economically. I think that, we're starting to see that. IAMGOLD at Cote put an autonomous fleet in for their haul trucks, right? And it really de-risks workforce inflation or challenges related to getting a big enough workforce to run some of these big projects. So we're seeing it happen. Mining is a slow rolling game where we look decades into the future or whether these projects are going to be viable. So it's certainly a slow adopter, but we're starting to see some of this come in.
Yeah, it's very interesting. And in terms of the automation side of things, I mean, do you get the sense that it's working quite well in terms of reducing costs, for example? And could you see what maybe was a slow move all of a sudden, speeding up? If all of a sudden everybody sees, hey, we're making a fortune, much more money here by automating. I mean, do you think this change will speed up from here?
Generally, that's how technology works, right? As we get on that kind of exponential growth curve, as the slow early adoption really proves its value, and we're certainly going to move in that direction, right? It's tough to integrate some of these early things and mitigate the challenges that come with them, but as we prove out the value, it makes a really compelling case. We're seeing that with electrification in underground fleets as well, right? Where the benefits are you need less air down there to run combustion engines. And so it's not necessarily the green energy, let's not burn diesel case. It's the case that we can effectively reduce our ventilation costs and have a net positive result by using electric vehicles down deep in these mines, right? And so I'm optimistic that things are moving forward. And at least I think we appreciate our social impact more these days too, which is a big step forward.
Okay, excellent. And in terms of exploration, of course, you're a VP of exploration at Axcap. What are you seeing, on the technological front there? What is it enabling to happen? Like, in a sense, is it helping solve this discovery issue, this kind of search for gold and this kind of low gradeism, for lack of a better term? What are you seeing on the exploration front?
It's allowing us to really start to build the data that we need and use it. I have this conversation with lots of people around how, we have this challenge where we have historic data that is deep and rich, but it's someone writing by hand on a piece of paper scanned. And then we have this, quantitative data that we say, yes or no to 100 check boxes. And it's trying to kind of find a way to communicate with technology and computers effectively so that we can leverage that. I don't know if we're fully there or not, but I think understanding that we need the data and we need the clean data and we need to figure out how to use it appropriately is a big first step to being able to use the advanced tech that we use. And I heard a pretty eye-opening stat that just kind of highlighted where we are in the space, where it said something like Netflix generates more user data per person per year than an entire mine creates. And so it's not that we have a data problem, it's that we have a lack of data problem. And, as we understand that and collect it, I think that the integration of tech is going to rapidly accelerate.
Okay, very interesting. So, putting it in more, say, practical terms, we've been keeping it fairly high level. When a new property is acquired or when you are exploring a new area, what is the process in 2025? I mean, what do you do? Do you first look for all the data and then do you send little drones over top that somehow do some sort of, magnetic sensing of some kind? What happens?
Yeah, so it's a deep dive on data. And nowadays we're fortunate where you can have someone write a script to scrub the 2 gigabytes of scanned PDFs that exist in the database, right? And in the last decade and a half, 3D modeling has completely changed, right? And so we'll build a new 3D model, with modern software and a modern approach, and then really start to interrogate the project from a modern perspective, looking at where we can leverage the data that exists and how our understanding of the best practices have evolved and how we can look at these projects differently. So co-metals, multi-element deposits and things like this that historically have been problems we look at from a modern economic lens, where often now those are big benefits.
Okay, interesting. So it sounds like to me you start with data, right? So where are you getting the data? Is there always data? I guess in some cases there's more data than others. Is it the previous companies that were there? Do they share or do you inherit the data? Where does the data come from?
Yeah, and so this has been a big part of our strategy within Axcap, has been to buy data-rich projects for effectively cents on the dollar of what was spent to collect that data or create that data. So, we're able to buy projects that have 40 years worth of exploration and development work completed on them with reasonably intact data. And to replicate that in today's cost environment would cost tens, if not hundreds of millions of dollars. So it's a big part of our strategy that we need to buy good quality projects that have a good legacy, because there are projects that have gone through the other side of legacy where there's nothing left, where even, the core and the rock samples are gone. The filing cabinets that stored the material were lost in a fire or things like this. And the only legacy is a hole in the ground. And it's hard to rebuild value from something like that, especially under the current 43101 guidelines that require validation of historic work and things like that. So having that data attached as part of the legacy of the project really drives substantial value and is a big part of our model.
That is super interesting. So, in a sense, the more data you accumulate, to a certain degree, I mean, ultimately, the rocks in the ground are what's going to determine the value of your project. But in the early stages, the more data you have, in a sense, in some respects, the more valuable the project is, rocks aside, which of course are crucial, but it's a very important component to the value. Would that be fair?
Oh, big time. And a prime example of what's happening today are these projects in antimony, right? No one cared about antimony. No one wanted it. People didn't assay for it. They assayed for gold only. These were gold projects. Antimony was bad. You didn't want to show you had it, right? This is the history of those projects. And today, that co-metal is, worth as much or more, particularly if you want to get a project permitted quickly, right? And so if you didn't have the core, or if you didn't have the historic rock samples that you're able to go back and reassay them, or you didn't have the data to show, oh, there were some samples taken that showed that this was a co-metal byproduct, you wouldn't be able to recreate that without re-drilling that hole or without going back out and redoing that field work. And so we're able to capitalize on those types of opportunities by ensuring that the legacy of the project is intact.
Is there an obligation on the part of the company to keep that data, or it's just in their self-interest because they can sell it for more if, say, they're getting rid of a project? It's just going to be more valuable if they have the data, so they're going to keep it. But you're saying sometimes it gets lost. Like, is that correct?
It does. So in different jurisdictions, there's different regulations. In Canada, particularly, around flow-through requirements, you have to report on that. And that's part of the value that you're building for that tax credit is you're building this public data or this data that is attached to the project that will continually be available. In other jurisdictions, the land is totally privately owned. These are legacy from the gold rushes in the 1800s, and there's no requirement to maintain any data from anything like that. And so it's up to the legacy and history of the landholder. And, I don't have to tell you, mining has, is cyclical and has its ups and downs. So projects go through varying phases of economic viability. And sometimes the priority is not to spend money to preserve a core yard or a warehouse. It's, to keep the lights on, right? So things get lost, but it also presents, big opportunities if you can dig in and find value there.
Okay, very interesting. It's almost like you'd have to scan old news reports when you're talking about the 1800s and hope to put some data together there. Very interesting. And just finally on this, you're basically saying Axcap, its strategy is to find data. So in a sense, it's probably so much more expensive to create your own data. Like, in a sense, that's what you're doing. You're kind of leveraging the data. Do you ever have to send out a drone, or I don't even know what you do? Like, what do you do in 2025 if you're trying to create data? I guess drilling?
Yeah, you keep drilling. You get the advantage of, you don't have to do incremental drill holes to increase a resource. The resource already exists. It was drilled off by previous operators. You get to take those kind of aggressive exploration swings while, still underpinning the value by what was done in the past. There's lots of really great new kind of innovative techniques in geophysics and things like that really help image subsurface. People are starting to use satellites as receivers to speed things up, make things more efficient. The AI machine learning applications to look at 20 or 30 layers of data are starting to show some good value where I think a good operator can see through maybe 4 or 5 layers, right? When you start stacking all these different variables together, it gets really, really complex, and the computer's pretty good at diving through that. So, these are some of the aspects that we certainly look to leverage.
So you're in exploration, or at least with Axcap, you're VP of exploration. We've seen in the news, in the last couple of years, governments have taken pretty big interest in mining. And, we've seen in Europe, there are these projects that are designated strategic. We see Critical Raw Materials Act. We see what's happening in the United States with this kind of almost an obsession with natural resources and particularly the metals. And we see what's happened with rare earths. So first of all, are you seeing any real change to your business? Are things getting easier for you, or are these simply still headlines that you're still waiting for the real world effects to happen?
It's the first time in my career that we've seen federal governments on both Canadian and the American side of the border really promoting mining domestically. I kind of look at it as the early stages of something, that resembles a more of a fair trade commodity industry. Like what we've seen in coffee and cocoa kind of style, where the source of supply is valuable and matters, where all of the nickel that produced in the world doesn't just go into the London Metals Exchange and come out at the same price. And so I think there's value in that. I think, clean, socially responsible operations should see a premium compared to, really, really polluting mines. It's how we need to transition the mining industry into something that isn't viewed based on its past. So there's a big part of that. I'm really optimistic about building domestic supply as well. We're going to need more supply of everything if we want to kind of make an energy transition. I always say if we want to build the world that we see in futuristic movies, there's a lot of materials that need to come out of the ground. And so any progress towards that, I think, is really good. For Axcap, it was part of our model to be in Canada and the US only. We wanted the stability of those jurisdictions. We felt that the model around gold's price increase and value is tied to a domestic supply in our model. And so having Canada and the US assets only was important, and we think that has worked out well based on what's happened. And also we touched on the federal support, having federal and state alignment towards getting projects built in Nevada is going to be beneficial. We're guiding a PEA on Converse, our Nevada asset, early Q4 of this year. And really that's in preparation to look at, these fast track programs that are being put in place in the US so that we can get this mine permitted under an administration that is pro mining and pro development.
So right now, it sounds like it's still in the headlines, though. Like, in a sense, you haven't changed how you're doing business at all. You just have maybe better expectations. Would that be accurate?
I would say we've accelerated our plans. We think that there is a very compelling window here in the next 3.5 years to make serious headway on projects. And so where we wouldn't have necessarily looked to push that permitting as hard, we would have looked to develop and de-risk the project maybe in other ways. We see a real opportunity here to advance this asset quite quickly. I would say broadly, it is still a headline thing at the moment. We don't have those really critical minerals. We're dominantly a gold play. And I think we'll see the critical nature of gold play out over the next couple of years.
Some people do consider gold a critical metal. The whole discussion, I mean, it seems like they're all pretty critical to somebody, all of these metals. We saw MP Materials get a pretty significant investment. It seems like we may be at the dawn of a new era, Blake, in terms of public-private partnerships, particularly in North America, where, even the word subsidy is, frowned upon. I mean, and I don't know if we could actually even technically call it a subsidy, what happened with MP Materials, but you're starting to get, what I think we could call like public-private partnerships going on here. How do you feel about that? Like, do you feel like the industry, you were mentioning before, there's not enough exploration, like it's probably because there's not enough funding, right? Like, in a sense, does the industry need this sort of thing? Like, what are your thoughts on, what could be the beginning of something here?
I think it's a good sign. We always kind of say money doesn't have the patience that mining requires, right? So seeing this kind of collaboration, this more long-term strategic approach around supply, maybe we'll start to provide that patience that's required, or that certainty that is required. We operate in a pretty cyclical world, and if you can calm that down and provide a little bit more long-term consistency through these partnerships, then I think there's good value there. It presents a pretty good opportunity for a little bit more broad retail or the broad market support, where traditionally these projects have been funded by more resource only focused funds.
Exactly. And I mean, we have this kind of weird tension really between these projects which take years and an increasingly fast market to a certain degree where cycles seem to be shortening. And so, to your point, It's not very easy for miners to really get the long-term money that they often find in places like China. So it is an interesting situation here. Just finally, I mean, in terms of jurisdiction, you mentioned, being pretty North American focused. Is there anywhere in North America that you're particularly excited about? I mean, you're in Nevada. What other areas do you think are kind of interesting right now?
So we're Nevada, Wyoming, and British Columbia. We like all of these jurisdictions. They're all very pro-mining jurisdictions that have a long history of reasonable regulation around development. So that's really what I'm optimistic about, are states and provinces that want mines to be built. We've seen this happen in Wyoming. Our neighbors to the north in the state, US Gold, have effectively taken their project from a science project to a permitted, build-ready asset in something like 14 months. And really just shows that Wyoming is super open for business. And these are the kind of states that we want to operate in, that, welcome the investment and the opportunity to build value in their states. We'll continue to look for opportunities, and that'll be a big part of our focus.
Blake McLaughlin, Vice President of Exploration at Axcap Ventures. Thank you for joining us and sharing your perspective on this week's Northern Miner podcast. Thank you once again to Blake McLaughlin for appearing on this week's episode of the Northern Miner Podcast. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.